decreased interest rates by 25 bips. We've seen our own Reserve Bank decrease interest rates as well. And we look and consider the impact that these moves have on markets. At the start of this year, we began to see a normalization, or what looked like a normalization. It looked as though interest rates were going to start increasing. It looked as though fundamentals became important again, and that the market was beginning to shift away from being so moved by the movements of central banks throughout the world. But we've seen that geopolitical tensions have continued. There are trade wars still ongoing between China and the US, and those scale up and scale down through the months as various issues are raised and then disappear again. But the trade wars still continue in the background. We've also started to see heightened tensions in the Gulf region as well, between the US and Iran, and also the UK, with tankers passing through the Straits of Hormuz being targeted. There is a UK tanker that's currently been taken over, and the UK have also got involved, turning an Iranian tanker back on its way to Syria, and those tensions continue to escalate. We still haven't seen Brexit being accomplished. We don't know if there will be a deal or no deal, but the UK does have a new Prime Minister in the form of Boris Johnson, who was a very staunch Brexiteer, and we'll see whether the UK on the 31st of October decides to leave the European Union with a deal, or whether they go ahead with no deal in place. So all of this has had an impact on global growth, and we have seen concerns around global growth and the ability of global growth to continue, which is why we saw a decrease in US interest rates by the US Fed. A lot of that was probably driven by very staunch political pressure on the Fed, but the Fed deciding to take a mid-cycle pause and to readjust and to bring interest rates down. Locally, we've seen a continued economic malaise and the impact that this has had on markets. Eskom continues to really be a thorn in the side of the economy and government and economic growth, requiring further bailouts, and we seem to be a long way from them getting their house in order. We've also seen that a lot of South African consumer-facing businesses have come under significant pressure. The latest set of results from Massmart indicating just how pressurized the consumer environment is, and how businesses are struggling. And this is weighed together with the impact of the state-owned enterprises and the inability of government so far to push forward structural reform on the market and the bond market as well. We've seen that bond yields have retraced back to higher levels after coming down significantly, and we've seen that foreigners have actually been net sellers of the South African bond market. So if we look at performance of the various sectors within the JSE, we see that we can definitely see the local economy is very much still under pressure and hasn't been favored and hasn't had the tailwinds that the global economy has. It's really been hampered by domestic headwinds and a consumer that's feeling the pressure and the strain of 10 years of a lack of economic growth and escalating unemployment. We've seen strong performances from the likes of Naspers and other Rand hedge stocks who earn a vast percentage of their earnings from offshore markets, and those counters have continued to perform strongly. We've also seen that the resource sector has been able to benefit from the increasing commodity prices and being able to restructure their businesses to be more efficient. And that's come through in the share price of those counters. But locally, the domestic facing businesses have come under significant pressure. If we look at the healthcare and industrial sector specifically, a lot of those companies really feeling the pressure of an economy that's not growing and a consumer who is constrained. Liquidity has also begun to dry up in the market. So we've seen that trading volumes have decreased. The values traded as well as the volume traded has come off from previous highs. And a lack of liquidity means that we've seen increased volatility within the equity markets, and particularly within the mid and small cap sectors as well. Very few stocks move, and as those stocks are traded, it causes fairly significant changes and swings in the prices that those shares trade at. I mean, Italtal is as an example of this, is a share that is quite closely held already, and that also doesn't trade vast volumes in the market compared to the top 40. And we can see quite vast swings in the price of that counter as there is some trade happening in the counter. So as liquidity has been withdrawn from the market, we've begun to see increased volatility, which really isn't helping the mid and small cap sectors at all. But there is value in the market. There are counters that continue to be incredibly well priced for a very poor outlook, which could improve. But there are three things specifically that need to happen in order for value to even start unlocking. One is that earnings growth needs to come through and be strong. So companies need to be able to tap into growing their earnings, and earnings growth will come through if the economy begins to show signs of a little bit more strength. So it is a bit of a vicious circle. We require that the issues at Eskom are stabilized, even if they're not sorted out completely in the short term. We do need to see a more clear path to how those issues will be resolved, if nothing else, to help spur confidence. And once confidence is increased in the economy, that could do a lot towards unlocking some kind of growth. And then easier monetary policy. We've got incredibly high real interest rates at the moment, and some kind of alleviation of interest rates will help to take some pressure off the consumer, and to do a little bit to stimulate consumer spend. The Reserve Bank governor indicated that although he was going to put forward a rate cut, that rate cuts alone are not going to be the panacea that will unlock economic growth. But they do go a long way towards putting more money in the pocket of consumers, and to also help increasing consumer confidence. As interest rates are cut, it provides a reprieve to consumers who are paying back debt on mortgages, on credit cards, on vehicle financing. If they've got a little bit more money in their pocket each month, it means they can go out and increase their spend, which will help those companies that are highly geared to the South African consumer. As those companies are able to sell more, they're able to improve their growth and performance, and through increasing the bottom line are able to make more investments into the economy. They're able to hire more people. More people in the workforce means there's more people earning money, more people to spend, and so the cycle continues. But rates and the level of interest rates in the domestic economy are really only one of the levers. There's a lot more structural reform that needs to happen in order to increase confidence of businesses, so that businesses are happy to spend, but also to increase confidence among foreign buyers as well, to reduce the risk premium that the SA market is currently facing. And if we look at the level of real interest rates, we can see that there definitely is room for South Africa to cut interest rates further. We are still very dependent on foreigners and foreign flows. And although we've seen that foreigners have been net sellers of our market over the past couple of months, if we get some stabilization in terms of policy and the outlook for the economy, the foreigners will come back into our market as yields locally offer good compensation for the risks that they may take. And currently our real yields are in line with Brazil and much higher than many of our emerging market peers, and also much higher than the level of rates that can be found in the developed market as well. So with the Fed cutting rates last night, there is still scope for our local Reserve Bank to cut rates further, while still offering a premium to what developed market yields are offering.
Okay, morning everybody. This is Nadir here. So, I mean, if we against this backdrop of what we need to stimulate growth in the local economy.
If we turn to the domestic economy, we can see that from a valuation perspective, our market still is looking attractive. We've seen that PE multiples have come down, and that dividend yields have held up strongly. And when looked at from pure valuations, the market still offers some attractiveness.
Okay, so morning everybody, this is Nadir. So I mean, so against this backdrop of probably an economy that needs to be stimulated in order to generate some kind of earnings growth, so that we can unlock a lot of the value that we see present in domestic markets, there could be over-optimism in terms of the opportunity presented within the local market, given how much multiples have unwinded and the kind of dividend yields which we're trading on, which Claire has already touched on. But what you have to be really careful of in this environment is not being caught up in companies which are optically cheap and could potentially be offering value traps. We all know about the pitfalls now in hindsight of what Tongaat was offering. But there really were warning signs prior to the fact, which indicated that Tongaat were on an unsustainable path. The kind of cash flow generation that you were getting, was declining at a rapid rate. it wasn't necessarily being reflected all that much in headline earnings, because headline earnings were being boosted by a number of other IFRS and accounting measures. But if you looked at the free cash flow that was available from operations, that was continuously declining at the same time that the company was massively leveraging up their balance sheet. So if you look at it, by the time shares in the company were suspended, total debt was at about 8 billion rand. The market cap of the company was just over 1.5 billion rand. And they were basically taking on all this debt just to sustain their operations, given that the sugar price had collapsed and they're ultimately operating within a commoditized market. And obviously, later on, we've now found out that, there could be potential accounting irregularities there and the shares being suspended. I suppose the overarching point is that while this company appeared optically cheap for a long period of time, if you actually dug deeper and you try and figure out what is the quality offered by this company, potentially the kind of deteriorating or improving multiple, should I say, it was trading on, was really probably quite fair given the massively deteriorating prospects of the business and free cash generation. And in this environment, I think this is going to be a theme that's going to be that market participants continuously need to be on the lookout for, in terms of not being caught in a value trap, and in terms of not investing in the businesses purely because they trade cheaply, but there must be some kind of catalyst to unlock value, and the quality of the company can't be all that compromised. And if we look at an example of some of the companies which offer this kind of quality as opposed to just being a value trap, MultiChoice has probably been one of the better examples of this. So what we show in this chart is that the profit margins of MultiChoice are exceptionally healthy at a gross profit margin of around about consistently in excess of 40%, and an operating profit margin consistently around 15%. What this meant is that the group actually generates quite a lot of substantial free cash. Yes, they've had to suspend the dividends this year with expectations that they're going to resume around 2.5 billion rand of dividends in the next 12 months. But what has enabled them to generate this phenomenal amount of free cash is, the high operating profit margins and the way that that's protected, which is kind of the moat into the business. And within that, obviously, the multiple continued to be, at the time of listing was exceptionally attractive, given that, a lot of the market participants were concerned about Africa prospects and, getting Africa to break even in the amount that's costing the business. And then also the threat of disruption from OTT operators like Netflix. But it seems that, the strategy of the company continues to be well deployed in terms of narrowing the losses from Africa, and they continue to deliver on that promise, and having a strategy to get that to break even. Ultimately, getting Africa to break even and profitability within the next 3 years is a very definitive catalyst to unlocking value within this company. And supporting that is that even though you have declining average revenue per users very marginally in a tough economic environment, they're still managing to maintain their operating margins at around about 15%. And you see the restructuring announced in the business where there's going to be retrenchments. That's ultimately about keeping cost growth well below revenue growth, and as a result of that, maintaining the margin. So this would be an example of a domestic business, which is higher quality, and that's why we've seen the share price of this company do as well as it has since it's listed. At around about just over 130 rand a share from the listing price of 95 rand a share when they spun out of Naspers. And potentially further upside should they get Africa to break even. But ultimately, this is an example of how a high-quality company with domestic prospects has managed to succeed in this environment. And I think another important point to mention is the fact that this is a large cap stock. And given the drying up of liquidity, which Claire mentioned earlier, the mid-cap stocks, even the ones with good opportunities, are battling to find any bids, given that, market participants are not going down the cap spectrum in a low confidence environment. So, something like MultiChoice and the banks, which we'll get onto in a second, have not necessarily suffered from that same problem, given that they are large and quite liquid. So if we look at another example of how quality has prevailed in the domestic market environments, in what's been a tough environment, one has to look no further than the banks. You'd expect that both banks and retailers are very much leveraged to the prospects of the domestic economy. And as a result of that, you'd expect them to trade fairly similarly from a share price perspective, given the prospects of the macro economy in South Africa. That, however, has not been the case. We've seen our banks significantly outperform our retailers, as indicated by this graph, probably delivering double the performance that the banking sector has, and this is including the renegade period of December 2015, which is that first small blip you see on this graph. So delivering double the performance over a period where both sets of companies have been faced with very tough local economic conditions just shows how quality businesses can prevail over poor quality businesses, and sometimes perhaps being too focused on the short-term PE multiple is not necessarily always the best way to be managing money. Ultimately, the banks have been very well provisioned. They've continued to grow their earnings in the low double digits, off revenue increases in the high single digits. They've kept their balance sheets in pristine condition. Their non-performing loans, as a result, haven't gone through the roof. They haven't overextended themselves in terms of capex like parts of the retail sector has. And this conservative management of their balance sheet, maintaining their return on equity and the quality of the business is a strategy that has paid off and shown that these businesses, despite facing the tough or the challenging local conditions, have managed to deliver performance and ultimately have been the winning horse to back in what's been a tough local economy. And then if we look at, so given the extent of the bank's performance, you'd expect their multiples to be quite expensive. But if we look at, how the banks are trading relative to the overall market, at PE multiples kind of still in the very low double digits to high single digits, depending on which bank you're talking about. Remember that the banking index line in this graph has been skewed by Capitec, which is in that index, and obviously Capitec trading at a much higher multiple given the kind of growth rates they're delivering. But if you look at the likes of Standard Bank or ABSA, to a lesser extent FirstRand, which is probably the high quality pick out of the big four, but Standard Bank and ABSA still trading in the mid single digits, still trading on very good dividend yields, and the PE multiple differential relative to the rest of the market still quite high. So what that means is that even though banks have massively outperformed retailers, they haven't necessarily outperformed the rest of the market, particularly the big rand hedge weights in the index. And what this has meant is that multiples, when compared to the rest of the market, haven't run away from the banks. And this is just an example of how being exposed to high quality names in a very poor growth environment locally still has been the best strategy. And as long as we're in this low growth, low confidence quagmire, is probably going to be the best strategy going forward, rather than trying to call the bottom on a number of leveraged domestic retailers or a number of other domestic stocks which are very leveraged towards the domestic consumer. So the way that we undoubtedly playing this through our equity building block is that any domestic exposure we do have is to the high quality domestic stocks, as opposed to being into the leveraged, highly geared to a local recovery retailers or some of the other stocks within the local economy. So a lot of questions that we get asked is that what is going to be the impact of the downgrade, and are we going to see further significant outflows from the bond markets in the event of getting a ratings downgrade? And our view on this is that you've got to take a very sensible and rational approach to it. And ultimately, a downgrade is being priced into South African markets. If you look at our sovereign risk premium, which is the grey portion of these bars, we are very much in line with Brazil, who are one rating level below us. According to S&P and Fitch rather. So to a large extent, a further downgrade in South Africa's debt is already priced in. With an additional bailout that's been provided to Eskom for the next 3 years of a further 110 billion rand in funds over the next 3 years to basically keep it as a going concern. Moody's has already flagged this as credit rating negative. Fitch has already downgraded our outlook from stable to negative, where they already have us in junk status. So in all likelihood, it seems increasingly unlikely that South Africa is going to be able to avoid a further ratings downgrade. But the reality is that this is already priced into markets, and to become excessively bearish on fixed income once this has already been priced into markets is probably at your own peril, especially given the kind of real yields we're seeing on offer from the bond market now, with inflation remaining fairly well anchored at around about the midpoint of the target band, and yields on our 10-year paper, now in excess, just under 9%. That still gives you in excess of a 4% real yield on 10-year government bonds. And in that kind of space, as long as the global environment is remaining very accommodative, and that remains a big caveat, the global environment does need to remain accommodative as is currently, it seems fairly unlikely that there's going to be a drastic impact on the South African bond markets in the event of a downgrade later this year in November, when we are up for a review in Moody's. There might be a knee-jerk reaction initially as the forced sellers in terms of the index trackers exit, but that will be fairly short-lived as active investors come back in. Moving on to the global environment, potentially our greatest concern is that earnings growth in the US in particular has stalled. If we look at the earnings growth numbers coming out for the first quarter of this year, we sort of in an environment where instead of earnings going down by 2% this quarter, we're likely to see earnings only contract by just under 1%. The markets are taking that as a positive, but ultimately earnings growth is still contracting. Outside of a couple of the very large tech stocks, Microsoft, Amazon, Google, or Alphabet, which is the parent company, we are continuing to grow at very prolific rates. Facebook, having their best quarter in history, despite having to pay a $10 billion fine on the back of privacy valuations, or $5 billion fine, rather, $5 billion settlement on the back of privacy concerns. The tech stocks still continue to grow at a prolific rate. Outside of that, earnings growth seems very sparse. And what this chart, which we took from The Economist, shows is that ultimately profits as a share of GDP within the US has stalled for probably the last 5 years, but has really gone into flat territory more recently. And there doesn't seem to be an end in sight to this outside of a couple of very large tech shares which are taking the lion's share of growth. What this ultimately means is that with multiples having stretched to fairly expensive territories at around about 17 to 18 times forward earnings within the US, markets continue to be fairly reliant on central banks keeping policy rates low, central banks keeping stimulus and liquidity plentiful, in order to maintain, the kind of equity market rally that we've seen into the start of 2019. And we saw indications of that coming through, subsequent to the Federal Reserve's comments made after their decision to cut interest rates yesterday. So there's merely a statement made from Jerome Powell that, further interest rate cuts are possible, but are not necessarily a foregone conclusion. They're going to remain very data dependent, and currently, and to cut interest rate further, they're going to have to see signs of marked weakness within the US economy. And currently, the data is not indicating that. And, we saw the S&P 500, the Dow Jones, and global indices around the world selling off quite vociferously on the back of that. In fact, selling off more than 1%, which is their first daily move, more than 1% in 35 trading sessions. So it just shows how sensitive investors and the global markets are to ample liquidity and plentiful and low interest rates in order to sustain the current multiples, given that earnings growth is in a very narrow sector of the market and not as broad-based as what investors would like. So, Claire touched on it at the beginning of the presentation in terms of, the kind of heightened uncertainty that there has been, in the global political environment. And this graph basically just tries to quantify what impact that uncertainty has had on global stock markets. Obviously, we've seen a significant rally since the start of 2019, as indicated by the maroon line. But the reality is that the uncertainty, the growth effect, from equities and from expanding multiples has been a lot more, than what the actual performance from equities have been. And that's really been because the uncertainty impact, if you try to break this up into the two parts, as the BlackRock Investment Institute here has tried to do, but the uncertainty impact has been weighing down on equity market performance, which could have been even more severe. And that uncertainty impact is really the impact of, no deal Brexit, the impact of US-China trade relations, the impact of, potentially a flaring up of tensions within the Middle East and the Straits of Hormuz, and what that's meant for capital allocation decisions from companies. So part of the reasons that earnings growth has been so narrow within the US is that companies have not been investing a lot of capital in order to generate earnings growth, but have been quite conservative in the capital allocation decisions. So this graph basically just tries to quantify the impact of all that uncertainty on the lack of investment, and consequently what impact has that had on the prospects for equities to deliver further growth. And what you'll notice from this is that the uncertainty, the impact of the uncertainty effect has been quite severe in global equities, and in the absence of global central banks propping up liquidity and maintaining those expanded multiples, the impact of that uncertainty impact would be even more severe. So the reality is that in the absence of that central bank liquidity, we really do need to see earnings growth coming through on quite a strong basis. And that's not necessarily the base case forecast going forward for the remainder of 2019. The reality is that the alternative to equities is a very poor alternative. If we break down global yields, with global yields across all countries at the moment, basically 25% of all global government debt is trading in negative territory. That's a staggering number. If you look at Switzerland, all the way from 1 to 50-year debt for Swiss sovereign debt is trading in negative territory. If you expand the definition further, for half of global government debt is trading at less than a 1% yield. That's a staggering statistic. And as a result of that, in this very low yield environment, investors continue to be forced into equities. And the reality is that, if we see these yields kick up to any kind of meaningful effect, that could drive outflows from equities, and we could see the rating of equities be weighed on quite significantly. We could see companies' cost of capital going up as bond yields go up. And then that margin between the return on investment that they get and their cost of capital could potentially narrow. And what that would mean is that, the future prospects of the company are going to be discounted at a higher discount rate. The profitabilities are going to be smaller. And that obviously is likely to have an impact on the kind of valuations that global equities trade on. But in this low rate environment, if this low rate environment continues into the foreseeable future, that is likely to be fairly supportive of risk assets and maintain the current multiple that they do trade on. Within this graph, it's not very clear here, but it's trying to show the impact of fiscal stimulus and credit stimulus or monetary stimulus within the Chinese economy. The bottom line is that China is trying to manage the slowdown in growth in the economy. And every time we see an escalation in trade uncertainty with the US, we see China stepping in with massive amounts of fiscal stimulus, not necessarily monetary stimulus. But we continue to see the impact of that on managing the Chinese growth number, and any kind of the indication is that any kind of uncertainty on the trade front, which is going to weigh on growth going forward, as we saw in the second quarter, that number coming in at a 30-year low, even though it's still growing rapidly at 6.2%. That's the Chinese economy. Policymakers stand ready to add stimulus in, particularly on the fiscal side, to continue to support the economy. And this is very important for emerging markets, sentiment towards emerging markets, and emerging market growth in general. China obviously continues to be a major trading partner of all emerging markets, given their commodity demand. So if emerging market growth is going to remain robust, and in the case of South Africa, not deteriorate further, it's fairly important that China continues to grow, at that kind of 6% level, and manage their way through the transition from investment-led growth to consumption-led growth, particularly as the political risk and the risk from deglobalization rise, and what impact that might have on longer-term prospects. Just finally, and wrapping up the presentation here, and we're happy to take questions subsequent to that if there are any questions, is that global investors are running out of patience with emerging markets. And this is an important theme, because structurally going forward, if it's going to form a smaller part of global developed market investors' portfolios, we're unlikely to see those flows coming into emerging markets and unlocking the big discount that they currently trade on relative to developed markets. And some of the factors that's causing them to lose patience with emerging markets is the fact that the convergent story of emerging markets converging towards developed markets in terms of infrastructure, in terms of productivity, in terms of size of the economy, those gains have really seemed to be slowing over the last couple of years. And what that ultimately resulted in, as this graph, which we borrowed from the Financial Times, has shown, is that ultimately foreign direct investment into emerging markets in general has started to slow down, which is potentially the first sign that deglobalization is hurting significantly. We see increased protectionist stances being taken, not only from Trump in the US, but ultimately from the UK and a number of other regions around the world, trying to stimulate demand within their own economy and create jobs within their domestic economies. And what this has ultimately means that if deglobalization is happening, emerging markets are ultimately the biggest losers from this. And as a result of that, the convergence trade of increasing consumption, increasing GDP per capita could be potentially slowing, and developed market investors might be losing patience in terms of unlocking of value from emerging markets. So this is a theme that we continue to watch very closely, because it's obviously fundamentally quite negative for emerging markets over the long term. It's not necessarily something which is fully gained traction, but something that should be a tail risk, which is or kind of a black swan event, which you need to watch out for over the long term. I think for the time being, obviously, multiples in emerging markets are discounting this probability, which is why they continue to trade quite cheaply, which is why even if you look at the JSE, we continue to see outflows, foreign outflows. We continue to see the market trading on a discount relative to developed market counterparts. And that this could potentially be part of that reason, and something which needs to be borne in mind as a black swan event going forward. So that's really where we'll wrap up. That looks like we don't have any questions, but if there's any follow-up questions, we're happy to take them. You can just pop us an email or whatever. And at this point, we'd just like to thank you for joining, and thank you very much.
Yeah, we'll make these slides available to anybody who would like a copy of them. But yeah, just to summarize, I think, in terms of our portfolio positioning, there are opportunities out there in the market, specifically when we look at valuations and the valuations of domestic equity. Offshore markets have run hard and are quite pricey, but there are still pockets of opportunity there. So really, it's all about navigating the risks as it has been for the past 18 months. And we continue to evaluate and to be active in our positioning. And if that's all, if there are no questions, thank you for joining us. The slides will be available. Please feel free to contact us, and we'll do this again next quarter.